Okay, so let's dive in. Welcome to the deep dive. Today, we're looking beyond just, the houses themselves. We're really pulling back the curtain on the whole machinery behind real estate. It's this
Yeah.
huge mix of finance, complex tax stuff, social history, policy, even high-stakes deals.
That's exactly it. And our goal here, well, it's to sort of weave together all these different threads. We've got sources on like the nitty-gritty finance stuff, leverage, tax loopholes, but then also the really big picture historical forces, things like segregation policies, financial crises. We want to connect those dots for you, show how making money in real estate today is tangled up with all this history.
Yeah, and what's really fascinating, I think, is this tension our sources point out. Real estate, fundamentally, it's this massive, slow-moving thing, right? Building wealth takes time, decades sometimes. But then it's value and how quickly people can make money. It gets hit by these super fast, short-term plays like a 45-day IRS rule or really sharp negotiation or how the market jumps when policy changes. It's like a marathon and a bunch of sprints all at once.
Okay, let's jump right into that financial engine. Leverage. You hear it all the time. Building wealth fast in real estate often means using other people's money. OPM.
Oh, absolutely. Leverage is, well, it's foundational. Some call it the eighth wonder of the world
Yeah.
because it just compounds so powerfully. See, unlike buying stock where your profit's just based on your own cash appreciating, real estate lets you magnify returns because you control the whole asset, but you only put down a fraction of the cost.
Right. Can you give us some like concrete numbers? Show us how that works. Yeah, we looked at a great case study for this. Imagine you put down $10,000 to buy a $100,000 property. So you're leveraging 90% of the price, right?
Yeah.
Now let's say that property goes up just 4% in a year. That's pretty modest. That's $4,000 in value. Your cash-on-cash return, just from that appreciation, is 40% because it's $4,000 profit on your $10,000 down. Now, if you put that same $10,000 in stocks and it grew 4%, you'd have $400. Big difference.
And the sources point out that you're also paying down the mortgage principal each month, so that equity growth actually speeds up over time.
Exactly. The models we looked at show that, yeah, a 4% appreciation can actually lead to maybe 24% average annual growth in your equity once you factor in paying down that loan balance. So that initial 10 grand, it could easily become over $55,000 in equity in just a few years. You're multiplying your starting cash like 5 times over just through debt and, a stable market.
That compounding is powerful for homeowners or small investors. But let's scale it up. What about commercial deals? Bigger numbers, bigger risks.
Okay, yeah. Think about a $1 million commercial rental. Maybe you put down $100,000 cash, finance the other $900,000 with a 30-year loan. Let's say the potential gross rent is, I don't know, $148,000 a year. After you pay all your operating costs and that huge loan payment, maybe you're left with around $12,500 in positive cash flow for the year.
Okay, so how do you judge if that's actually a good deal? That's where cash-on-cash return comes in.
Correct. You take that annual cash flow, the $12,500, and divide it by the cash you put in, the $100,000. That gives you a return over 12%. That number, the return on your cash, is what makes carrying that $900,000 debt make sense. But, and this is crucial, that leverage cuts both ways. If the market dips or values fall, your $100,000 is the first thing to get wiped out. It magnifies losses just as much as gains.
Right. So to figure out if that cash flow is real and sustainable, investors use a specific language, specific metrics. It's not just about collecting rent checks.
No, you have to get precise. You start with the ideal scenario.
Right.
Gross scheduled income. That's if every unit is rented every day at full price. But reality bites, right? So you subtract vacancy and credit loss, empty units, tenants who don't pay. That gets you to gross operating income, GOI.
Okay, and from there we get to the really key number for valuation, net operating income, NOI.
Exactly. Net operating income, NOI, is your GOI minus all the operating expenses. That's stuff like property taxes, insurance, management fees, repairs, maybe some utilities. But here's the critical part. NOI doesn't include the mortgage payment, the debt service.
Why not? Why leave out the biggest expense for most people?
Because NOI is meant to show the property's earning power as an asset, separate from how any particular owner finances it. A good property should generate solid NOI no matter if you paid cash or got a huge loan. But, and the sources really stress this for newcomers, NOI also usually leaves out capital expenditures, or CapEx, reserves for big stuff.
Okay, that sounds like a potential trap. What's CapEx and why should you track it even if NOI ignores it?
CapEx is for the big, expensive things that don't happen every year but you know are coming. Replacing the roof, a new heating system, repaving the parking lot. If you don't set money aside for that stuff, create reserves, your cash flow looks way better on paper than it actually is long term. Lenders might just look at NOI for the loan, yeah, but smart investors, they calculate their own cash flow after setting aside money for CapEx. That tells you if the deal really works over 10 years, not just year one. Got it. So once you have a solid NOI, you can figure out a price using the capitalization rate, the cap rate. Yeah. How does that work? What does it tell you? The cap rate is just the NOI divided by the property's value or price. It basically tells you the return you'd get if you bought the place all cash. Yeah. But it's also kind of a proxy for risk and how easily you could sell it. A low cap rate, maybe 3.5% in a super hot market like, say, downtown Manhattan, that means investors feel it's really safe, really liquid. They'll accept a lower return for that security. A high cap rate, maybe 9% in a smaller town or a rougher area, that signals higher risk. Investors demand a bigger return to deal with that uncertainty.
Okay, so the cap rate is like the property's natural return. Then you compare that to your borrowing cost to see if the leverage helps or hurts.
Precisely. Now you're looking at positive or negative leverage. You compare the cap rate to the loan constant. The loan constant is just your total annual mortgage payment principal and interest as a percentage of the loan amount. If your cap rate is higher than your loan constant, boom, positive leverage. The property is earning more than the loan cost, boosting your overall return. If the loan constant is higher, that's negative leverage. Your financing costs are eating into your profits. Maybe you should have put more cash down, or maybe the deal just isn't right with current loan terms. Hashtag 1.3 advanced tax strategies in real estate.
All right, beyond cash flow, let's talk taxes. Because honestly, this seems to be where a lot of the serious wealth generation happens in real estate. Not just income, but tax savings.
Oh, absolutely. The tax code is incredibly favorable to real estate investors. The big one is depreciation. It's a paper expense. You don't actually spend cash, but the IRS lets you deduct it. For a residential property, they say the building wears out over 27.5 years. So you get to deduct a piece of the building's cost, importantly, not the land value, every year, even if the property is actually going up in market value.
And there's a way to turbocharge that. That's cost segregation.
Exactly. A cost segregation study is basically an engineering analysis of the building. Instead of just depreciating the whole structure slowly over 27.5 years, they break it down. Cabinets, fixtures, carpet, special wiring, even some landscaping elements. These things have much shorter, useful lives in the IRS's eyes, maybe 5, 7, or 15 years. So you can depreciate those components much faster, taking bigger deductions up front. Accelerated depreciation, it creates these huge paper losses early on.
Wow. So pushing decades of deductions into the first few years, that must make a massive difference for people with high incomes.
It's game-changing. We saw this example. Someone earning $400,000 a year uses cost segregation on a new property. He'd generate maybe a $50,000 passive loss on paper in year one from that accelerated depreciation. That loss can potentially offset their active income, dropping their taxable income to $350,000. If they're in a high tax bracket, say 45% combined state and federal, that $50,000 paper loss just saved them over $22,000 in actual cash taxes right now. It's basically one of the best legal tax shelters out there, especially if you qualify as a real estate professional under IRS rules.
Okay, but hold on. It sounds too good to be true. Does the IRS just forget about those deductions later? What's the catch?
Ah, yes. The catch is called depreciation recapture. It's not quite free money forever. While those depreciation deductions save you taxes year after year when you eventually sell the property, the IRS makes you recapture all those deductions you took. You have to pay tax on them. It's usually taxed as ordinary income, up to a maximum rate of 25% currently. So, smart investors factor this future tax bill into their calculations. If you don't plan for recapture, you could get a nasty surprise when you sell.
Which brings us neatly to the classic strategy for avoiding that tax hit. The 1031 like-kind exchange.
The 1031 is the investor's best friend for deferring taxes. It lets you sell an investment property and roll all the profit, including the amount subject to depreciation recapture, into buying another like-kind investment property. You don't pay capital gains tax, you don't pay depreciation recapture tax yet, you just keep deferring it, potentially for your entire investing career. It's how portfolios grow tax efficiently.
But the rules are notoriously tricky, right? Especially those deadlines. They create a ton of pressure.
Oh, incredibly strict. 2 killer deadlines. First, the 45-day identification window. Once you close the sale of your old property, the clock starts ticking. You have exactly 45 calendar days, weekends, holidays, everything counts to formally tell the IRS, usually through an intermediary, which specific properties you might buy as replacements. There are rules on how many you can list. Second, you have to actually close on the purchase of one or more of those identified properties within 180 days from your original sale date. Miss either deadline by even 1 day. The whole exchange fails. All your deferred gain becomes taxable immediately.
Man, 45 days to find and lock down deals in a hot market while juggling financing or inspections, that sounds incredibly stressful.
It really is. And there's another wrinkle, boot. If the property you buy is worth less than the one you sold, or if you take any cash out of the deal, that difference, the boot, is taxable right away. So you generally need to trade up or sideways in value and reinvest all the proceeds. It's complex, high stakes, but absolutely essential for serious long-term investors.
Okay, one last tax angle. Mixing personal use with investment strategy.
Right, that's using the IRC 121 exclusion. This is for your primary home. If you're married filing jointly, you can exclude up to $500,000 of profit from capital gains tax when you sell your main home. The rule is you have to have lived there for at least 2 out of the last 5 years. So an investor might live in a property for 2 years, sell it, take that tax-free gain up to the limit, and if their profit is more than $500,000, they could potentially use a 1031 exchange for the rest of the gain, rolling it into a pure rental property. It's a neat way to combine personal benefit with investment deferral.
All right, we've got the math, the leverage, the tax perks, but none of it matters if you can't actually get the property in the first place. Let's shift gears now to, like, street-level tactics. How do you find and acquire deals, especially if you don't have a ton of cash?
Yeah, this is where creativity really comes in. If you don't have the big down payment, you have to make up for it with hustle, finding deals, structuring things differently. Hashtag tag 2.1, different paths to acquisition.
Okay, let's start with something a lot of people try when they're starting out. Needs almost no cash. Wholesaling.
Wholesaling is basically being a deal finder, an intermediary. You hunt down a property, usually one that's distressed or where the owner needs to sell fast, often below market value. You get it under contract to buy it. But then, and this is the key, instead of buying it yourself, you sell the contract to someone else, like a landlord or a house flipper. You charge them an assignment fee for finding the deal and locking it up.
So you never actually own the house. No loans, no carrying costs. What's a typical fee for that?
Exactly. No ownership headaches. The fee really depends on how good the deal is, how much discount you found. But it could be anywhere from, say, $500 up to $10,000, sometimes even more on bigger deals. It's popular because the barrier to entry seems low. But one critical thing the sources mention, your purchase contract must have an assignability clause. If it doesn't say you can assign the contract, you could be stuck, legally unable to sell it. That causes major problems.
Okay, moving on to a more involved strategy, one for building a portfolio faster, the BRRRR strategy. Buy, rehab, rent, refinance, repeat. Sounds like manufacturing equity.
That's a perfect way to put it. You're forcing the appreciation through renovation. The whole point is to pull your initial capital back out so you can do it again. We saw a classic example. Investor buys a rundown house for $29,000, puts $12,000 into fixing it up strategically, total cash in, $41,000. Because they did a good job on the rehab, it now appraises for $70,000.
Okay, then the magic part. The refinance. This is where they get their cash back.
Yep, they go to a bank using that new $70,000 appraisal. The bank gives them a loan based on a certain loan to value, maybe 80% LTV. So 80% of $70,000 is $56,000. That's the new loan amount. Since they only had $41,000 invested initially, they get that $56,000 loan.
Yeah.
Pay back their initial $31K. And they walk away with $15,000 in tax-free cash because loan proceeds aren't taxed. And they still own the property, which is now hopefully cash flowing.
Wow, so they basically got the house for nothing out of pocket, maybe even made cash on the refi, and still own the asset.
Pretty much. In that example, after maybe some closing costs, they might have left only a few $1,000s in the deal. And the property started cash flowing, say $5,400 a year, so they got that remaining cash back within the first year. Then they take their original capital, plus maybe that extra cash, and rinse and repeat. Find another deal. Do it again. It's intense. You need no construction, manage rehabs, but it's a powerful way to scale quickly. Hashtag tag 2.2 navigating financing challenges.
Okay, but getting that financing, that's still the big hurdle for most people. We know about regular mortgages, but what are the specifics for investment properties?
Right, a standard conventional loan from a bank. For an investment property, they'll usually want a bigger down payment than for your own home, often 20%, sometimes 25% minimum. That reflects the higher perceived risk for the bank. You might find lenders specializing in investor loans who do 10% down sometimes, but for like apartment buildings, 30% down isn't unusual either.
And for people starting out, maybe buying a duplex to live in one side, the FHA loan is common.
Yes, but it's important to understand what FHA does. The Federal Housing Administration doesn't actually lend you the money. They insure the loan for the bank. Basically, they promise the bank they'll cover losses if you default. That insurance makes banks comfortable lending to people with lower down payments, sometimes just 3.5% down. But the big rule is you have to live in the property as your primary residence for at least 1 year. So great for house hacking, not for pure rentals you don't live in.
What about deals that need to happen fast or properties that are too beat up for a normal bank loan? That's where hard money comes in, right? Sounds expensive.
Very expensive. Hard money loans come from private lenders, maybe wealthy individuals, maybe specialized firms. They lend based primarily on the hard asset, the property itself. They're usually short-term, like 6 months to a year, meant as a bridge until you can fix the property and refinance with a bank or just sell it. Because they're fast and risky for the lender, the terms are rough. High interest rates, maybe 12% to 18%, often interest-only payments. Compare that to maybe 5% to 7% for a bank loan.
And they charge points, too. What are those?
Yeah, points are upfront fees. 1 point equals 1% of the loan amount. A hard money lender might charge, say, 3 or 4 points just to originate the loan. So on a $100,000 loan, that's an extra $3,000 or $4,000 you pay immediately on top of the high interest. You use hard money when speed is everything, buying at auction, grabbing a foreclosure before the bank lists it, situations where conventional lending is just too slow or impossible.
Is there an alternative if banks say no, maybe dealing directly with the seller financing? Why would a seller do that?
Seller financing can be a great option. It works when the seller basically acts like the bank and lets the buyer make payments over time. Why would a seller agree? Well, maybe they can get a higher price for the property this way. Or they like the idea of earning steady interest income. It can also help them spread out their capital gains tax liability over several years instead of taking one big hit. And for the buyer, it's huge if you have trouble getting a bank loan. Maybe you're self-employed, your credit isn't perfect, or you already have too many mortgages. It solves problems for both sides sometimes. Hashtag tag 2.3 negotiation tactics and contingencies.
Okay, so finding the deal, getting the financing. But the real win often happens right at the negotiation table. That's saying you make your money when you buy, creating that safety margin.
Absolutely critical. The sources we looked at were clear. Experienced millionaire investors don't just hope the market goes up. They build in profit from day one by buying right. They aim for a significant margin of safety, maybe buying at 20 or 30% below what they think the property is truly worth after minor repairs. That discount isn't just for future profit, it's insurance. It protects them if unexpected repairs pop up, or a tenant leaves, or the market softens a bit.
Hang on, that 20 or 30% discount, I mean, in today's market, in many places, that sounds almost impossible unless the place is literally condemned. Is that realistic? Or just an ideal?
That's a fair challenge. And yeah, you're not likely to get that discount on a nice house listed on the MLS that everyone wants. The sources emphasize this target is usually only achievable by going off-market or finding distressed situations. Think foreclosures, properties banks won't lend on, sellers going through divorce, job relocation, inherited properties they just want gone. Situations where the seller's motivation is high and speed or certainty matters more than top dollar. The investor's job is to find that pain point. So yeah, it's not an average market expectation, but it's the standard successful investors often require for a deal to make sense, especially with leverage. If they can't get that margin, they often walk away.
Makes sense. And a big part of getting that deal accepted is how strong your offer looks. Why is an all-cash offer so powerful even if the price isn't higher?
Cash is king because it usually means no contingencies. Contingencies are those escape clauses for the buyer. The two big ones are the financing contingency. I'll buy it if I can get a loan. And the inspection contingency. I'll buy it if the inspection is okay. An all-cash offer typically removes the financing contingency completely. The seller knows the money is there, the deal will close. Often, cash buyers might waive inspection too, or do it just for info. Less risk, less hassle for the seller.
We saw that great negotiation example with the disorganized seller, Big John. The buyer used the seller's own lack of paperwork to drive the price way down. How did that work?
Yeah, that was brilliant. Property listed at $500 K. But the seller had no good records, income, expenses. Who was even living there? No mess. The buyer didn't argue about the building's condition. He focused on the cost of capital needed to buy a property with no verifiable income. He basically said, look, because you have no records, no normal bank will touch this. I'll have to get expensive private money, hard money maybe, just to buy it. That cost me a fortune.
So he turned the seller's disorganization into his increased cost, justifying a lower offer.
Exactly. He anchored the price low, offering $200,000. He framed that huge $300,000 not as him lowballing, but as the cost of the seller's bad record keeping. And the seller took it. Why? Because the buyer offered a fast, clean, guaranteed closing. It solved the seller's immediate problem, even at a steep discount.
Okay, so if you can't go all cash, what else can you do in your offer to make it stronger, reduce the seller's perceived risk?
You want to make it as easy and predictable for the seller as possible. Offering to buy as is a big one. That means you won't nitpick over repairs found during inspection, though you might still inspect for major issues. Another tactic is making a net offer. You tell the seller the exact dollar amount they will walk away with, guaranteeing you'll pay all their typical closing costs, commissions, etc. That certainty is appealing. And if you do need an inspection contingency, frame it carefully. Tell the seller it's just for major deal-killing problems, not for negotiating leaky faucets. Show them you're serious about closing, not looking for excuses to bail or renegotiate.
Okay, we've spent a lot of time deep in the weeds, the math, the tactics. Let's zoom way out now, because the sources make it really clear. The real estate landscape we see today, who owns what, where wealth is concentrated, it wasn't an accident. It was shaped heavily by historical policies.
This context is absolutely essential. You can't really understand today's market dynamics, the supply issues, the wealth gaps, without understanding how these historical forces set the stage. It all connects. Hashtag 3.1, the role of government policy and segregation.
Let's start with something that sounds kind of boring, zoning laws, but which the sources show were actually used as weapons early on to create and enforce segregation.
Yeah, exclusionary zoning. This really took off after World War I. Towns and cities passed ordinances basically reserving certain neighborhoods, usually the nicer ones, for only single-family homes on big, expensive lots. The effect, and often the explicit intent, was to price out lower-income families, who were disproportionately minorities, make it too expensive for them to even move in. Sometimes it was framed as preserving aesthetics or preventing density, but often the racial motivation was pretty openly discussed back then.
And what's really startling is that the federal government wasn't just passive. Federal agencies actually pushed for segregation as part of their own financial policies.
That's a key finding, yeah. After World War II, you had the FHA, the Federal Housing Administration, and the VA, the Veterans Administration, guaranteeing mortgages to help people buy homes. Huge programs.
But their own official underwriting manuals, the rules they gave appraisers and lenders, they frequently recommended and sometimes flat out required that properties getting these government-backed loans have racial covenants written into the deeds. Covenants saying the home could never be sold to or occupied by minorities. What was the government's justification for demanding that?
Their manuals literally said that harmonious neighborhoods, which meant racially homogeneous white neighborhoods, were safer investments, less risky for loans. They explicitly told appraisers to downgrade the value of properties if they were near minority neighborhoods, and they created those infamous redlining maps coloring minority neighborhoods red, deeming them hazardous for lending. This effectively cut off access to capital, locking in segregation and disinvestment. It was official federal policy.
That system where the government and courts enforced private discrimination finally hit a wall with the Supreme Court in 1948, right? Shelley v. Kramer.
That was a landmark case. The court didn't say private covenants themselves were illegal, but it said that if state courts enforced them, like ordering a black family out of a house they bought in violation of a covenant that was unconstitutional state action, it violated the Equal Protection Clause of the 14th Amendment. Basically, it took away the government's power to enforce private racial discrimination in housing contracts.
But the damage was already deep by then, and segregation continued in other ways. What was the lasting economic impact on communities of color?
Oh, it was devastating and long-lasting. By systematically limiting where African Americans could buy or rent homes, these policies created this artificial scarcity in the few areas they were allowed. Basic supply and demand took over, rent and home prices got pushed way higher in black neighborhoods compared to similar housing in white areas. It effectively siphoned wealth out of those communities.
Yeah.
And because they were largely excluded from those FHOVA loans that were building massive wealth for white families in the suburbs, it prevented generations of black families from building that same kind of home equity.
And even after Shelley v. Kramer, federal policies continued to reinforce these patterns, right? Like with urban renewal.
Absolutely. Federally funded urban renewal programs in the 50s and 60s often targeted minority neighborhoods deemed blighted. They used eminent domain to clear vast areas, displacing thousands. Critics often called it Negro removal. The cleared land was frequently sold to developers for projects that served wealthier, often whiter populations, with little provision for rehousing those displaced. Plus, think about the interstate highway system, also federally funded. Route planning often deliberately cut through minority neighborhoods, destroying homes and businesses, isolating communities, and reinforcing segregation with concrete barriers. Hashtag 3.2 urbanism and suburban shifts.
Let's shift focus a bit to the physical shape of our cities. The American pattern of suburban growth is pretty different from many other parts of the world.
Yeah, it's a really interesting contrast.
Yeah.
You look at big cities in Europe, Asia, South America. Historically, the wealthy and powerful tended to live right in the dense historic city center. The outskirts, the periphery, what we'd call suburbs, that's often where the poorer populations ended up, crowded together, often far from good jobs or transport.
But in the US, we saw the opposite, especially after the 1920s. A huge movement out of the city centers into these sprawling, low-density suburbs. What drove that?
One major trigger the sources point to was, believe it or not, the car and parking. By the mid-1920s, there were just too many cars for the old downtown street grids. Parking was a nightmare. Traffic was choked. Businesses started realizing the traditional city center was becoming inconvenient for mass access.
And retail led the charge outwards.
Seems like it. Robert E. Wood at Sears was a key figure. He saw that for their big, new department stores, their A stores, they needed huge amounts of easy, free parking to attract customers driving in. You just couldn't do that efficiently downtown. So Sears started building these massive stores out in lower density areas, surrounded by parking lots. That move really prioritized car access over everything else and pulled shoppers and eventually residents out towards the periphery, fueling suburban growth.
That suburban model was dominant for decades. Now, though, we hear about the great inversion, wealthier people, young professionals, empty nesters moving back into city centers. What are the implications of that shift?
Well, the economic trend, who moves where, that changes. But the sources emphasize the underlying responsibility stays the same. Whether people live in the core or on the edge, whether they're rich or poor, the goal should be providing decent, safe housing and good, affordable transportation options that connect everyone to opportunities. The challenge with the inversion, or gentrification, is managing that change so that long-time lower-income residents aren't displaced and the city core remains accessible to everyone. Hashtag 3.3 financial crisis, complexity, and risk management.
Okay, last section. Let's look at how finance itself, specifically complexity in finance, almost blew up the whole system back in 2008, largely fueled by real estate.
Right, the subprime crisis. A huge factor was the shift in banking from the old originate and hold model where banks made loans and kept them on their books to the originate and sell model. Lenders figured out they could make really risky loans, subprime loans, to borrowers with shaky credit and then immediately sell those loans off to Wall Street investment banks. This created a massive moral hazard. The originator didn't care if the loan failed later because they didn't own the risk anymore. Their incentive was just to make as many loans as possible, regardless of quality.
So the risk just got passed up the chain. Wall Street bought these questionable loans and bundled them into incredibly complicated products.
Yeah, they packaged thousands of these mortgages together into collateralized debt obligations, CDOs, bonds backed by mortgage payments. The complexity was insane and fatally flawed. The big investment banks, Lehman, Merrill, Goldman, they paid rating agencies like Moody's millions to bless these things. And the models they all used made this unbelievable assumption that housing markets in different parts of the U.S. wouldn't all crash at the same time. They thought the risks were uncorrelated.
So the idea was, even if houses defaulted in Florida, it wouldn't affect California or Arizona much.
Exactly. They used fancy math, like the Gaussian-Coppola model, which seriously underestimated the chance of a nationwide downturn. This flawed math allowed them to slice the CDOs into different risk levels, or tranches. They sold the riskiest bottom slices for high yields, but they stamped the biggest top slices with AAA ratings supposedly super safe. Pension funds, cities, conservative investors bought these AAA slices thinking they were as safe as government bonds. But they were ultimately backed by piles of shaky subprime mortgages.
And the market itself eventually stopped believing the ratings, right? Even when the models said things were okay.
That was the crazy part. Towards the end, these AAA subprime CDOs, which the math models might still value at, say, 95 cents on the dollar, they were trading in the actual market for maybe 70 cents on the dollar. The traders knew something was deeply wrong, that the ratings were meaningless. But the whole machine was built on originating, packaging, and selling. It couldn't stop itself until the whole thing just seized up and collapsed.
It's a terrifying story. What's the lesson there for an individual real estate investor today trying to manage their own risks?
It comes back to diversification and understanding your personal liability. Systemic risk, like the 2008 crisis, shows how correlated things can become, how everything can go wrong at once. For an individual, that translates to not putting all your eggs in one basket, especially if you're the one personally guaranteeing the loan. It's generally much safer to have smaller stakes in multiple deals, say, owning 20% of 5 different properties, rather than being the sole guarantor on one huge high-leverage project. If that one big project fails, the lender can come after all your personal assets. Spreading the risk limits your personal exposure if one deal goes bad. Helps you sleep better, too. Hashtag shag outrage.
Wow, what a journey through this material from like the 45-day rule for a 1031 exchange all the way back to FHA redlining maps and then the complex math that failed in 2008. It really changes how you look at things. You can't just see a cap rate now without thinking about all these massive forces, finance, history, policy, all tangled up together, shaping today's market, shaping who has wealth and who doesn't.
Absolutely. And that interplay is only getting faster and more complex. We're seeing the rise of prop tech real estate technology. These platforms are bringing sophisticated data analysis, market intelligence, stuff that used to be only for huge institutions. Now it's available to almost any investor. You can get incredibly granular data, instant news updates, analytics to help you spot trends and make decisions based on hard information, not just gut feelings.
That brings up a really interesting question, building on everything we've discussed. Historically, real estate seemed driven by these big, slow cycles demographics, interest rates moving gradually, federal policies taking years to play out. But what happens now? When investment decisions can be driven by real-time analytics, by AI predicting market shifts almost instantly, does that speed, that flood of data, actually change the fundamental cyclical nature of real estate? Will it smooth out the booms and busts? Or will we just find new, faster ways to be irrational? Something to think about.
Definitely something to watch. We hope this deep dive gives you the tools, understanding the strategies, the finance, the crucial historical context to think critically. Not just about potential investments, maybe, but also about the housing issues in your own community. Knowing how the machinery works is the first step.
Thanks for joining us on the deep dive.